Hey, welcome to another Jazz After Dark. How you doing out there? We are financial advisors here at Jazz Wealth, and this is our laid-back kind of class where we're talking about different things. Come, sample a drink with us tonight. We are trying. I think I got a little bit ripped off on this one. It's called Bowman Brothers. I asked for Buffalo Trace, and the guy said, "Well, this is the same mash bill as Buffalo Trace," and so I was like, okay, but then I look at the bottle and it says Virginia Straight Bourbon. Doesn't sound right. So nonetheless, got a piece of ice in there. Let's give it a try. Doesn't smell like Buffalo Trace. Oh, it's not bad. But if anybody knows, is that actually from the same mash bill? I don't see why that would be the case. But anyways, it's not bad. I haven't had it yet. So this is my neighbor, 3 levels down. He brought it over. He was watching the videos, and he's like, hey, try this one out. Give it back if you don't like it. Anyways, you don't care about that. This is our laid-back class where we just hang out, teach you something new. And my question today is the market going to fall more? I'll give you the answer. No, it's not going to happen. Now, in the short term, it's not going to happen. Let's take a look at some things. So here's where we stand. Here's the S&P, and I just zoomed out basically to give you enough data here. Looking back over the last 4 years, we're covering a bunch of different scenarios here, different presidents obviously taking place. But you see that we stand roughly right around here. The markets have fallen. There's no doubt about that. What I did is I illustrated, and I put this in our Notes from Jazz email. If you don't know, every week we do an email, usually every week. Sometimes if it's a holiday or I just get busy, I can't do it. But every week I like to do an email for clients and go, here's where we're at. Here's something new you may not have known, and let me try to teach you like a lesson using stats instead of my opinion. So I put the following slides in here. Number one, if we need to get to a 10% correction, you're going to look for the S&P to be at 5530. That's what would actually give us our first 10% correction in over going on 16 months. So a part of me is like, yeah, we're gunning for that, right? But we have some issues. We'll talk about that in a second. If you want to look at a 20% correction, just to get an idea of how far that actually is, 49.15 is where you'd be. We'd be all the way down here. There is, in my opinion, there is no chance we make a beeline for that number, meaning we just go straight down, and that is just beyond impossible, and I'll explain as we go here. So the S&P, no doubt, is pulling back. It's a good thing. The Nasdaq, well, it's already fallen 10%. What we did here is we said, hey, let's change it to red. Every time we fall in 10%, let's color code it red. The Nasdaq actually falls 10% more than the S&P does, and that's just lately because the tech component of the Nasdaq is more volatile. So you'll see many, many more scenarios where that happens. Well, I also made every other scenario where it was a 10% rally. Let's make that in green so you can see. Well, the Nasdaq's already there as of me recording this now, and to be honest, it's Sunday night. It's March 8th or something like that. March 9th. And so this we can focus on because we have our 10% correction. Is it normal for it to go more? Right? And again, if you're a client, I expanded on all this in the Notes from Jazz. If you're not a client, well, I would say, what are you waiting for? We're the 66th best advisor in all of the United States, according to USA Today, not myself. So I'm sorry, I'm not an egotistical guy, so that's hard for me to do. Anyways, so 10% correction. A lot of people look at 10% corrections and they say, that's a sign to do something. Now, I would argue it's a sign to move cash from your 401k into your investments and things like that, and don't have cash on the sides or money market funds or guaranteed funds, whatever. I would argue that it's a time to get with your advisor and talk about conversions. Should you be doing conversions? If so, how much? And should we do them now? Huge advantage. Actually, Chris is going to send out an email going over the details on that. It's really cool. And I would argue that this may be the time, if you're NASDAQ focused, maybe to scale in. Not an all or nothing. And why do I say that? Because if we go to the data here, don't let this scare you. Corrections in the NASDAQ, we're currently 10.4%. Again, it's the weekend. But the average correction in the NASDAQ is much more than just 10%. And again, that's just a factor of having those big tech names actually pull the NASDAQ down. The median 16.6%. So you say, well, we may have a bounce inside of here. If you go back to what the NASDAQ has done, it's sort of fallen in a straight line. There's a chance that we have people trying to buy this little short-term dip. But on average, if you're looking, you can expect probably a little bit more. If the S&P falls 10%, The Nasdaq tends to be around 17%. Well, the average actually plays out for that to be true. Also, we've spent 80 days correcting, meaning falling from the high all the way down to, at this point, 10%. Well, the average is only 74 days and the median is 60 days. So that brings you back to the idea that, in the short term, we likely have a recipe for a bounce. Okay, right? I mean, it makes sense. People will see this as a discount. In the midterm, hey, we got a new president. We've got new things going on. We have repricing of tariffs that for the moment are actually being enforced and will stick that way. And that brings me actually to Trump. We're not going to make this a Trump conversation. Love him, hate him, whatever. That's who we have to deal with. And we've got to adjust to what's going on out there. We don't want to get all fired up and mad and holding protest signs. We want to go, well, what do I do? Right? I don't like the guy. I want to do this. Or I love the guy. Thank God. I want to do this. Great. Let's work on that. I'm dead inside. I don't care if you like him or don't really. But we have a wild difference here. So take a look at this. Trump in his first term, going back up, the term, right? So here's the performance of the S&P during his first term. No doubt a lot of volatility in there till the end of his presidency. And we got a feel for his style and all of that. Every president's the same. But this term so far, we're going the other way. This is actually the worst performance so far of a president since Obama, which is not far. Obama, we had a 19% pullback. So you look at this and you go, okay, we're like from his high, we're just over 5%, 6% pulling back. It doesn't seem that big of a deal, right? So I don't know what his approach is. I'm not helping or picking on him. I'm just saying, wow, wildly different than the first time he actually did this. So let's go back a step then. Why do I believe that the market is not going to make a beeline for the 20% decline area? Like we're not just going to go straight down. Well, that has to do with something called the market internals. You ever heard that before? Market internals. Has anybody had this before? I don't know. It's getting weaker, actually, as I taste it, but it's not bad. Anyways, the market internals. Here's a couple of them for you. So when we say internals, all we're saying is, hey, let's track different areas of the market aside from price. Oh, the market fell 5%, or the price went from here to here. Okay, fine. Let's track other things. Let's look internally to the market and see what's going on. Well, if we look at the S&P 500, what I've done is plotted a couple things for you. The percentage of stocks above their 50-day moving average and 200-day moving average. What's the point of that? Think of it as like if you were to go buy a truck. I've used this example before, but if you were to go buy a truck, would you be comfortable knowing that you walked onto the dealership and found the truck of your dreams, right? And you bought it cheaper than the last 50 cars that sold on average, trucks, sorry. Would you be really comfortable if you bought it cheaper than the last 200 trucks on average? Probably, right? I mean, who knows? Maybe you got the best deal. Maybe it was kind of an okay deal. As long as it was better than the average, you'd feel pretty good about that. Well, we do the same in the stock market, but we look at all 505 stocks in the S&P and we say, well, okay, tell me the ones that are trading cheaper than their 50-day price average. So it's not like a magic, crystal ball or anything. All we want to know is that when most of the stocks are trading below their 50-day average, maybe that represents a discount. Doesn't mean it's a discount, right? But maybe it does. And then over a longer period of time, if you say, well, I'm more of an investor, I'm not a trader, well, then we look at the 200-day moving average. Show me all the stocks that are trading cheaper than their 200-day average price. So if you only invested one time a year, you'd say, I just want to know that I paid less than the 200-day average. I got at least a deal for the year. Well, when we look at the S&P, we find that the majority of stocks are now trading, this is the percentage, by the way, trading below their 50 and 200-day moving average. So the reason I don't think the market just falls straight 20% is because you have a lot of people that will look at those stocks and see or perceive a value. And we'll take a shot. Well, that buying volume will create these, you've seen it, right? We fall and then we have the snapback day and then we fall on a snapback day. Those are people scaling in, right? There's millions and millions of people playing in the stock market. You go, okay, so there's going to be the perception of value there, and that'll create these little short-term bounces. The other thing is the valuation of the overall market. The price to earnings ratio, meaning the price of a stock relative to the earnings that it has. If you're familiar with Shark Tank, right? Somebody comes out and they're like, I've got this new button and I want to sell this button for, and you could buy 10% of my company for $1 million. And then they go, well, what's your sales? And they'll be like, it's $100,000. And I sold $100,000. And they'll go, you mean you want me to pay 100 times, right? Because it's 10% for $1 million, your earnings. And let's just say that was their earnings, not sales. Maybe that's a value. I don't know. There's lots of companies that trade for those ridiculous valuations. But when we look at the price relative to the earnings that you pay for a stock in the S&P, we were trading at almost 28 times earnings. In other words, you would need operational excellence out of these companies, the average stock in the S&P as a whole, to make more money. It's a tough number, right? It's a very elevated and high number. Well, over the last couple of weeks, we've seen that navigate itself back down under 25. I'm not saying that's a discount or that would qualify as a value relative to history in the S&P, but I'm saying it is better than where it was. So the price relative to the total combined earnings of the S&P has gotten better. Well, what happens there? That causes people to perceive value again. So when you look at the market internals, there's lots of others that we could do. You find a reason for, maybe not everybody, but for people to go, that's a deal. That's something I want to participate in. So there you go. The market falling, 20% from here over time. Yes. In the short term, if you're looking into the next week or 2 weeks here, I just don't see how you get that, right? There's just too much perceived opportunity from people who maybe had money on the sidelines. You know that money market funds, the amount of money in money market funds right now is the greatest it's been since before the financial crisis. That money's got to go somewhere. And there are people waiting going, hey, there's a 10% discount. I'll put a little money there. I'm glad for that discount. We're now in March and we've fallen so far that we're all the way back to where we started in October. There's going to be people that do that, myself included, just with a little bit, right? Just sprinkle in. We're not backing the truck up and dumping a bunch of money in there. We're just sprinkling in a little bit of money. So there's where we're at with the market. And more from a data perspective, rather than just sit here and go, here's my opinion and you should trust me because, whatever. I like the data. If you like the data, you'll love the channel. Hope you stick around here. Jazzwealth.com if you want to work with advisors that don't make emotional decisions, but rather very data-driven decisions. And like I said, ranked 66th best in the entire United States, thanks to USA Today. And we didn't pay for that. They just did it. And we're thankful. So, yeah. Good night. At Jazz Wealth, we treat you like family. That was going to be our slogan, but the employees here took it a little too seriously.
You bought what? That wasn't in the plan that I built for you.
Oh, quit crying.
Don't spend one more dollar.
I'm gonna start calling you Sylvester because you sound like a real...
Tú siempre estás llorando como un bebé, llorancito.
I'm not mad. I'm just disappointed. That's how you get your identity stolen.
We decided to go with let our family be your family's advisor.